The year is 2025. Bitcoin, once a niche digital asset whispered about in online forums, has cemented its place in the global financial landscape. A key driver of this mainstream adoption? Bitcoin exchange-traded funds or ETFs. These investment vehicles offer a regulated and familiar way for both institutional and retail investors to gain exposure to the world's most famous cryptocurrency. But as with any nascent asset class, the path of Bitcoin ETFs is not without its bumps and turns. The allure of Bitcoin as digital gold has been a compelling narrative, especially in an era marked by geopolitical uncertainties and inflationary pressures. Investors, seeking a hedge against traditional market volatility, have flocked to Bitcoin ETFs, injecting billions of dollars into the space. However, recent market dynamics have painted a more nuanced picture, one where resilience and fragility coexist in an intricate dance. After reaching dizzying highs in late 2024, Bitcoin ETFs experienced a significant correction in early 2025, with flows plummeting by roughly 12%. This dip, equivalent to approximately $5 billion exiting the market, sent ripples of concern throughout the crypto community. Was this a sign of waning institutional interest? Were retail investors getting cold feet? The answer, as is often the case in the world of finance, is complex and multifaceted. Recent data from CryptoQuant, however, offers a glimmer of hope. While the initial shockwave of the correction was undeniable, ETF flows have since stabilized, hinting at a potential bottoming out. This stabilization suggests that while some investors may have been shaken out, others remain steadfast in their belief in Bitcoin's long-term potential. The question now becomes, is this stabilization a temporary reprieve or the beginning of a renewed bull run? Much of the recent volatility in the Bitcoin ETF market can be attributed to the behavior of institutional investors. These whales of the financial world, with their vast resources and risk appetites, wield significant influence over market sentiment. 2024 saw an unprecedented influx of institutional capital into Bitcoin ETFs, fueling the asset's meteoric rise. However, 2025 has witnessed a marked shift in their behavior. Gone are the days of aggressive accumulation. Institutional investors, grappling with persistent inflation, rising interest rates, and geopolitical uncertainties, have adopted a more cautious stance. Their hesitation stems from the inherent volatility of the cryptocurrency market, which stands in stark contrast to the relative stability of traditional assets. This newfound hesitancy has created a sense of unease among market participants, as the actions of these whales have the potential to make or break Bitcoin's momentum. Section 4, Profitability, Paradox, Riding the Waves of Uncertainty. Despite the significant outflows and market volatility witnessed in early 2025, it's crucial to note that a majority of Bitcoin ETF holders remain in the green. Data suggests that the average realization price for these investors stands at $72,546, a comfortable margin above Bitcoin's current price of $87,000. This latent profitability, however, presents a paradox of sorts. On the one hand, it could be interpreted as a sign of underlying strength in the Bitcoin market. The fact that most ETF holders are sitting on gains, even after a significant correction, speaks to the asset's resilience. On the other hand, this profitability could breed a false sense of security, masking the underlying vulnerabilities of a still maturing market. The fear is that this unrealized profit could quickly evaporate if a large-scale sell-off were to occur, triggering a domino effect across the market. Section 5. Macroeconomic Tides, Navigating the Uncertain Future. As we stand at this crossroads, it's impossible to ignore the looming presence of macroeconomic factors that continue to shape the trajectory of the Bitcoin ETF market. Geopolitical tensions, fueled by ongoing conflicts and rising nationalism, inject a level of unpredictability into the global financial system. Inflation, while showing signs of easing, remains a persistent concern, prompting central banks worldwide to tighten monetary policies. These macroeconomic crosscurrents create both opportunities and risks for Bitcoin ETFs. On the one hand, Bitcoin's decentralized nature and limited supply make it an attractive hedge against fiat currency devaluation and economic uncertainty. On the other hand, the interconnectedness of the global financial system means that Bitcoin is not immune to broader market downturns. If the global economy were to slip into a recession, Bitcoin ETFs, despite their recent stabilization, would likely feel the heat. The road ahead for Bitcoin ETFs is paved with both promise and uncertainty. While the recent stabilization of flows offers a glimmer of hope, it's not a guarantee of continued stability. The market remains highly sensitive to the actions of institutional investors and the unpredictable nature of global macroeconomics. As we venture deeper into 2025 and beyond, one thing is certain: the story of Bitcoin ETFs is far from over.